Welcome back to the deep dive. Today, we're getting into the real economics of food delivery,
Mm.
specifically the whole cloud kitchen model that's blowing up in places like Kathmandu.
hmm
And we're asking one big question. Is this a defensible business model? Or is it, just a temporary fad?
We're trying to find a real economic moat, not just a shortcut that your competitor can copy next week.
Exactly. And for anyone in that Kathmandu market, the sources point to
Mhm.
this really painful situation. We're calling it the aggregator paradox.
Right,
You have platforms like Foodmandu and Patho Foods. You need them for market access.
right.
But then they turn around and take a devastating cut. What, 25, sometimes 30%?
It creates this, what we call profitless prosperity. The restaurant looks incredibly busy. Orders are flying out the door.
Right? You feel successful.
You feel successful, but you're not actually profitable. It's just not sustainable if you're trying to build a real company.
So our mission today is to, well, get into the nitty-gritty. We're going to break down the unit economics for 3 different models. We'll be using Nepalese rupees, NPR, to keep it grounded in that Kathmandu context.
The goal is to see if this cloud kitchen idea is a fortress or if it's just a tent in a storm.
So let's define the players. First, you've got your traditional restaurant, high rent, lots of staff.
A classic brick and mortar.
Then the aggregator-dependent cloud kitchen. Leaner, meaner, but still totally reliant on the platforms.
And finally, the end game, the goal, the direct-to-consumer, or D2C brand. And as we'll see, getting from that first step to the last it's a huge challenge.
Okay, so let's start with that traditional restaurant, the one stuck in the paradox. Let's do a cold autopsy on an order. Where does all the money go?
Okay, so let's model a standard delivery order. Let's say the average order value, the AOV, is about NPR 1,800.
1,800, okay.
First thing that comes out is your cost of goods sold, the ingredients. For a typical restaurant, that's around 33%. So NPR 600.
That leaves you with 1,200. Still looks pretty good on paper.
It does, but that's when reality hits. And it hits hard.
The commission.
The commission. At 25% of the full 1,800, the aggregator takes NPR 450, right off the top.
Wow.
Then you've got packaging, which people always underestimate. For good quality, let's say 5%, another NPR 90.
So after your food, the aggregator's cut and the box it goes in, what is actually left for the restaurant?
You're left with a contribution margin of NPR 660. That's 36.7%.
I mean, 36.7%. That doesn't sound terrible in vacuum.
It wouldn't be. But that NPR 660 has to cover these enormous fixed costs.
And that's the real trap, isn't it? We're talking about rent in a prime Kathmandu location that could be, what, upwards of 200,000, 500,000 NPR a month?
Easily. Plus your full front-of-house staff, your waiters, your hosts, the huge utility bills for a dining room.
The list just goes on and on.
This is the core structural flaw. You have this high fixed cost business, a real estate business, really, that's now completely subservient to a digital middleman. You're running faster and faster just to stay in the same place. It's a financial knife's edge.
It's a brutal spot to be in. So if that's the trap, the cloud kitchen is supposed to be the escape route,
Yeah.
right? It's a direct attack on that fixed cost structure.
Exactly. The whole principle is, as the source says, simple and ruthless. You get rid of everything that isn't making the food.
No dining room, no fancy location.
None of it. You move to some low-cost industrial park or a dense residential area.
It completely changes your risk.
Right.
So let's run the numbers again. Same NPR 1,800 order, but this time from a cloud kitchen. Let's say one in the healthy food niche.
Okay, and this is where it gets a little counterintuitive.
Wait, you're telling me the variable costs might actually go up. How does that work?
It's a strategic choice. Because you're in that premium healthy niche, you're using better, more expensive ingredients. So your COGS, your food cost, actually goes up. We'll model it at 40%, so NPR 720.
Okay, so more expensive food.
The commission is still the same, 25%. That's NPR 450. And your packaging is probably better, more premium, so let's bump that to 6%, or NPR 108.
So 1,800 minus 720 for food, minus 450 for commission, minus 108 for packaging.
Your new contribution margin is NPR 522, which is a 29% margin.
Hang on. So the cloud kitchen makes less per order than the traditional restaurant. 522 versus 660? That seems wrong.
It's perplexing if you only look at that one number, but this is the strategic genius of it. You accept a lower per order margin because your fixed costs have been annihilated.
Right. Your rent has gone from, say, 300,000 a month down to maybe 70,000. Your staff costs are slashed.
Exactly. The mountain you have to climb every month is so much smaller. Even with less profit per step, you get to the top, your break-even point, way, way faster. It's a vastly more resilient business structure.
So that better cost structure gets you into the game. But a cheap kitchen isn't a moat. Anyone can rent a cheap kitchen. The real advantage has to be built on top of that.
The moat is the brand. It's going direct to consumer. And that healthy food niche is the perfect way to do it.
Why that niche specifically?
Think about the customer. They're usually digitally savvy, they value consistency for their fitness goals, and they're perfect for subscriptions and loyalty programs. They have a really high customer lifetime value, or LTV.
This changes everything. The aggregator stops being your partner and becomes, well, an expensive lead generation tool.
That is the critical mind shift. Stage one is acquisition. You look at that 25% commission not as a tax, but as your customer acquisition cost, your CAC. You're paying the platform to bring you a high-value customer.
And stage two is migration.
Stage two is migration and retention. You have to pull that customer off the platform and into your own system.
And how do you do that in practice?
You use the delivery itself. Inside that premium packaging you're already paying for, you put a very clear call to action. A little flyer, a QR code, something that offers them, say, a 10% discount if they order direct from your own website next time.
You're using the product to acquire the relationship.
Exactly. You migrate them to your high-margin, low-cost system where you own the data.
Okay, let's run the numbers on that. The promised land. What does a direct order look like economically?
This is where it all pays off. AOV is still NPR 1800. Your high-quality CarGS is still NPR 720, and your premium packaging is NPR 108. But, and this is the big one, the NPR 450 commission is gone.
Wiped out.
Yeah.
But you do have new costs. You can't just ignore those. You have to actually deliver it.
Absolutely. So you add in your own delivery costs. Let's say using a 3PL or your own rider costs NPR 150 per drop. Then you have payment gateway fees for your website, maybe 3%. That's another NPR 54.
Okay, so the new variable costs are 720 plus 108 plus 150 plus 54, so 1,032.
Right. And your new contribution margin is NPR 768.
768.
That's a 42.6% margin. Now compare that to the aggregator's 522 or even the traditional restaurant 660. That huge jump, that is the engine. That extra cash is what you use to fund your marketing, your tech, your growth.
And crucially, you now own the customer data. You know who they are, what they like, how often they order. You can't do any of that when you're just getting pings from an aggregator's black box.
That data is the real asset. It's what builds enterprise value.
So this space is moving fast. If you get that D2C engine running, what's the next strategic move? What do you have to anticipate?
A couple of things are going to happen. First, you'll see the rise of the multi-brand cloud kitchen.
What's that?
A smart operator with one kitchen will launch several different virtual brands from it. A keto brand, a vegan dessert brand, a biryani brand, all listed separately on the aggregators.
To maximize the use of the kitchen, like what we saw with Rebel Foods in India.
Exactly. And you can be sure the aggregators won't just stand by and watch their best restaurants leave. They'll fight back. They'll launch their own kitchen as a service to get rent money, or they'll offer lower commission tiers to their biggest partners to keep them on the platform.
So it becomes a strategic tug of war. But the source points to one thing as the ultimate bottleneck, especially in Kathmandu, the final boss, so to speak. And it's not food, it's logistics.
Absolutely. The unique challenges of that city, the traffic, the unstructured addresses, the sheer cost of reliable last-mile delivery, that's the real barrier to scaling. The future belongs to whoever masters data-driven routing and hyper-efficient delivery.
So a food company has to become a tech and logistics company.
It has to. That is the hard truth. Opening a cloud kitchen is just buying a ticket to a much more complex game. The true moat isn't dug with cheaper rent, it's dug with brand, with customer data, and above all, with logistical excellence.
So whoever solves that last mile puzzle wins.
And that leads to a final, really interesting question for you, the listener, to think about. Given how critical logistics is, what existing low-cost delivery network, maybe the Postal Service, maybe a local courier company, what network could a smart cloud kitchen entrepreneur partner with or even acquire to solve that puzzle before the aggregators do it themselves? What bottleneck stands out most to you?